Hi, I'm Ray Kang, a commercial real estate broker working with landlords and owners and investors of retail centers here in Central and South Texas. What we focus on is property specific advisory, helping owners better understand what's happening in the market so they can make smarter decisions and ultimately make better returns on investment. This show is a weekly event, and we're here to keep an eye on the U.S. consumer and retail so you can stay more informed without having to chase headlines. So let's get into it. We're going to start with macroeconomic news and see what's shifting under the hood. First up is housing and affordability. According to a new executive order from the White House, the administration is taking aim at Wall Street's growing presence in single-family housing. Large institutional investors will face new restrictions while owner-occupants, especially first-time buyers, are being prioritized through first-look opportunities and limits on investor access to government-backed programs. Even though institutional investors are only about 3% of single-family rental homes nationally, their buying power is often concentrated in specific markets. The goal here is to reduce competition for families, stabilize housing costs, and support long-term household wealth. For retail, this matters because housing affordability directly impacts discretionary spending, household mobility, and neighborhood stability, all things that influence retail demand. Second, small businesses are holding up, but margins are tightening. According to Bank of America's latest small business data, profits were still higher in 2025 than in the year before, and profitability improved at the fastest pace in 3 years by October. However, costs, particularly wages and tariffs, started to eat into margins late in the year. The encouraging part is hiring. Small business hiring picked up toward year end, especially among small retailers, and payments to hiring firms were up about 7% versus 2024 averages. Small businesses employ nearly half of the U.S. workforce, so this is a meaningful signal. The mood on Main Street is improving, but owners need to stay nimble and cost aware as we head into 2026. Consumers are still spending, but saving is getting harder. Data from the Bureau of Economic Analysis shows disposable income barely kept pace with inflation late last year. Both incomes and prices rose about 0.4% in October and November, and the PCE inflation gauge is running about 2.8% year over year. Despite that, personal spending climbed 0.5% for 2 consecutive months heading into the holidays. The trade-off is savings. The personal saving rate has fallen to roughly 3.5%, down from over 7% before the pandemic. That tells us the consumer is still supporting economic growth, but with much less margin for error. Spending is continuing, but households are watching costs closely and managing more tightly. Lastly, on macroeconomic news, job security looks to be remaining solid. According to the U.S. Department of Labor, initial unemployment claims remain historically low, with the 4-week average sitting at its lowest level in 2 years. Companies aren't laying off workers in large numbers, even amid policy uncertainty and the rise of automation and AI. Employers still have leverage in hiring, but everyday workers continue to have relatively solid job security. Putting that all together, and the macro picture is this: consumers are spending, jobs are holding, and small businesses are operating, but everything is tighter, more selective, and more cost conscious. Now, pivoting to retail news, let's take a look at how retailers are actually doing in response to the current environment. First, discretionary spending is under pressure. According to Retail Dive, consumers are becoming increasingly cautious with big ticket discretionary purchases. Categories like furniture, electronics, and higher priced goods are seeing more resistance, while everyday needs and smaller ticket items are holding up better. For retail real estate, this reinforces why visit frequency matters more than aspiration. Retail centers anchored by daily needs, food, services, and value-oriented tenants are simply more durable right now. Second, online grocery sales are accelerating. Reporting from Chain Store Age shows online grocery sales surged 32% in December. This doesn't mean physical grocery is weakening. It means grocery is becoming even more embedded in how consumers shop. Strong grocery brands are operating in a true omni-channel environment. In-store, pickup, delivery, and subscription behavior. For retail center owners, grocery remains one of the strongest traffic drivers, but execution, parking, access, and ease of use matter more than ever. Next up is TikTok and retail and how they are becoming inseparable. The recent US deal involving TikTok is important not just politically, but commercially. TikTok has become a major retail discovery and sales channel. Social commerce on the platform now drives billions of dollars in retail sales, particularly in beauty, apparel, food, and impulse-driven categories. For retail real estate, this reinforces an important point. Brand awareness, product virality, and digital to physical conversion are tightly linked. Retailers that win online still need the right physical locations to support fulfillment, experience, and brand presence, but only in markets that convert attention into sales. I want to take a moment to highlight a partner of the channel, Share Scoops. Share Scoops is an AI-powered financial content platform designed to help advisors and financial professionals communicate more clearly and consistently with their clients. They specialize in turning complex economic and market data into content that's approachable, trustworthy, and easy to understand, and without spending hours every week writing or keeping up with every headline. If you're an advisor, broker, or institution looking to educate clients, build trust, and stay visible more efficiently, they've created a discounted sign-up link specifically for my audience, which you'll find in the description. So please check it out. Moving into our final segment, and as we wrap up, I want to challenge one belief I see a lot of retail center owners carry, often without realizing it. And the belief is, my property manager handles performance. Now, this isn't a knock on property management, but management and performance are not the same thing. And I wanted to bring up the difference, which is management keeps the lights on. Advisory oversight drives results. Performance comes from measuring rents against the market, actively leasing and re-tenanting with intent, understanding tenant economics, running financial analysis, not just collecting rent, and making strategic decisions before pressure shows up. This is exactly what we're doing right now, working through financial analysis, active leasing strategies, and market research to help owners see where their property stands and what levers actually move value. So the new belief I want owners to consider is this: advisory oversight, not just management, is what drives performance. That doesn't mean micromanaging. It doesn't mean reacting emotionally. It means staying curious and engaged enough to know whether your asset is truly maximizing its potential. Curiosity about whether your property is just being managed or whether it's being positioned to perform. And that's this week's Retail Weekend wrap up for January 20th, 2026. If you could please like and subscribe to the channel, it would be greatly appreciated. You can also follow me and our newsletter at stripcenteriq.com and on LinkedIn. Feel free to reach out with any questions or anything you think I could help out with. Until next time, take care.